Hello, everybody. It's Ethan Bellamy. I'm Managing Director for Midstream Strategy at East Daily Capital. It's December 20th, and welcome to the PetroNerds podcast. I'm your co-host with Trisha Curtis.
Hi, I am Trisha Curtis. I am your co-host as well for the PetroNerds podcast. This is our second podcast, and we've had some errors and some fun getting here, but hopefully this podcast will turn out really well.
We were just learning. So this week, let's dive in. We had WTI up 5%, closing 49 and change. Brent, $52. Natural gas up to 268, but energy equities went the other way. XOP down 5%, OSX down 3%, and the Libyan midstream index down 4%. Some other interesting stats. Frac crews were actually down 13 week on week. But the rig count in the U.S. was up 8 to 346. It keeps creeping up on higher oil prices. And then we had big news out of IEA, OPEC. Maybe we should start there, Trisha. IEA, forecast for demand in 21.
Yeah, it's still pretty sluggish there. So OPEC and IEA basically are echoing each other in near term. And so they came out with their reports, OPEC on the 14th, IEA on the 15th. They came out with their demand outlook and they revised it down a smidgen. And basically, they just revised everything down a little bit for 2020 and then a little bit going into 2021. And so they revised these down. They say, hey, demand's going to be a little softer than expected. And this is all on the back of oil prices are creeping to 49 WTI and Brent's, pushing above 50. So the fundamentals in the near term are not matching, I think, those outlooks. And if you break that down further, so if you actually pull back IEA's report and you look at what they're talking about, it gets back into the global aviation story and the shutdowns. So they're sort of honed in on these near-term shutdowns, and the market's either racing ahead. But we talked about this in the first podcast of how much fundamentals play a role. And at the end of the day, there's only so much froth you can put on the oil market. And really, I think particularly in this market, pretty hard to add too much of it. I'd love to get your opinion on that, but I think overwhelmingly the fundamentals are showing us that OPEC has cut production, and we see that in the OPEC figures. Also, super impressively, Libyan production went from 200,000 barrels a day to above a million barrels per day in a matter of 2 months, and that supply has been absorbed to the market. So if we're at $52 Brent, and we have that supply, you could have a little froth and vaccine hopes, but oil has not told us that story this entire year. We've basically been above 40 WTI from June, and we're just now creeping to that 49. To me, it's saying that the underlying fundamentals are relatively strong. And I say relatively because, 49, by comparison, this is much stronger than we were at, but this is no for sure or secure deal. It's just looking a lot better than it was.
Yeah, we're $95 off the bottom this year. So yeah, I'll take that. Yeah. I'll take that. And I think a lot of people will too. So yeah, Libya, they're at 1.4 million barrels a day. Iran said they plan to double production by the end of March. On top of that, we had a tanker attack in the Saudi port of Jeddah. Kind of interesting week in the Middle East. And to your point, the fact that we're holding up well in the face of the supply. I think it's telling one part of the story. So, on the one hand, this week we had the first healthcare workers in the U.S. start getting vaccines, which was interesting to see. And on the other hand, we've apparently got a new, more virulent strain in the UK that's enhancing lockdowns there. So the pandemic is getting more schizophrenic than it already has been. I'm still in the camp that once you start seeing a pool of people get vaccinated, that the demand for jet fuel is going to accelerate probably beyond what IEA and OPEC and everybody else thinks. And you and I have talked about this many times. All these forecasting agencies are always wrong and sometimes horribly wrong. And I don't think that anybody has a perfect crystal ball right now. And I expect everybody to be pretty badly wrong about how the end of 21 is going to be relative to now.
Yeah, I mean, you're right. These forecasts are. I mean, you have to be humble in forecasting. That's why I used to always hate to do them, because I just thought they were crap. When people forecasting production, back in the day when shale was surging and everybody was asking me to do a forecast, and I'd be like, ugh, I hate it. I don't mind doing these near term, like 2-year outlooks on production. And actually, I've been really confident about getting back to 50 before the end of the year, and we're hitting it. But I think a couple things to mention that you just talked. So it's not a more virulent strain in the UK. It's actually it's a correlation versus causation, and they haven't suggested that yet. It's the two are together. They've realized that there's been a rising case count in the past 10 days. So it's really, they think they're seeing a much more rapid spread in the past 10 days. And because of that, they basically canceled Christmas and changed all the, increased the shutdown measures and everything right on the back, like days prior to when they just said you could have more households getting together.
What does that mean?
So they don't think it's more death.
What does that mean to cancel Christmas? Just like festivities? And I mean, you lived over there, so what does it mean?
Yeah, well, they're rule followers. I mean, they put in these rules and they like expect everyone to follow. Here, we're just kind of like, I hope not everybody's getting together. It's not really enforceable over there. They're basically, they give guidance and guidelines, and then they also are trying to, if you listen to Sky News or BBC, you can listen to the Tories and the Libs like duke it out on these issues and how whether or not they should have policemen like knocking on people's doors at Christmas and counting how many family members are together in different households. So right up until like I think it was a day or two ago, Boris Johnson had basically come out and said you can get together for Christmas with one or two different households together, and then they cut that back down saying don't do it, basically stay home for Christmas, because they had 10 days of data suggesting that this virus is spreading super rapidly, and so that it's like an R0 4 or something. So anyways, that's happening. At the same time, we're seeing crude like go up. So to your point, there's a tale of two stories here, and I think that the vaccine stories that we did see, I mean, it's been over 2 weeks now that the first vaccines were being implemented, the Pfizer and BioNTech vaccine in the UK. And we started that last week in the US. And then we're already going to roll out this Moderna one as well, it looks like very soon. And that one, it looks like it's much better in rural communities as well, because you don't have to have the cold storage. So I think the market for sure is pricing that, like the actual stock market's pricing that in. But oil tends to, if you look over the cross of the year, oil tends to not necessarily follow the stock market. So oil prices were subdued, even though the market's ratcheting up. So oil tells you a different story. It told you throughout the course of the year how badly the economy was hurt and how bad the shut-ins and everything were, and how bad just like the oil sector was. And so now to me, it's telling me how it's recovering a bit. And it's largely recovering because of those supply constraints that OPEC Plus put in. And that's really coming from, I mean, if you actually look at the numbers from Saudi Arabia, I think we should think back to 2018, November 2018, remember when prices started cratering in December, and it was because we were producing 11 million barrels per day in the US, 11 million barrels per day in Saudi Arabia, and over 11 million barrels per day in Russia. And now we're producing we're still producing under 9 million barrels per day in Saudi Arabia and roughly 10 and change in Russia. So, I mean, it's a big drop. And then we've seen some countries eke out a little bit more production. But really, this Libyan story, and you mentioned Iran, I mean, Iran is planning on bringing these barrels back. And actually, there's a couple of stories, both that I've heard internally and externally that's been validated by the Wall Street Journal and Bloomberg, that Iran is already eking barrels back onto the market. So their exports are probably a little higher than they're suggesting, which means the market is absorbing that as well. And those barrels are probably going to China and Syria and North Korea. But I mean, the fact that that's happening is relatively impressive. And I think, my clients and folks know that I am not a long-term bull on oil prices, but I tend to be more near-term optimistic than most, because I think that the fundamentals suggest that 50 is sort of the magic number, and we're darn near hitting 50. And I think what's really, really important for people to appreciate and realize is how important that $50 number is. Like, honestly, the Russians probably are getting a little bit nervous that Brent is over $50, because when we start getting above 50, we start getting to this territory where folks within OPEC want to cheat. I mean, we saw the issues with Kazakhstan and the UAE at the last OPEC meeting, and they want to increase production. And actually, over the past month or so, they have eked out a little bit more production. And then interesting, last night, if you had listening to Bloomberg on a Saturday, they were talking about the OPEC Plus compliance and how these monthly meetings, and if you've listened to it, there's a lot of criticism on whether or not this is a good thing, that they're meeting monthly and then they're changing their targets. And they're arguing that this is actually really good because they can sort of micromanage the market and basically do this every month. And honestly, if you think back from a historical perspective, this is super historical. It's definitely unprecedented, the fact that they have sort of a long-term broad engagement for the next 2 years, and that they're going to be managing the market on a monthly basis. I mean, you and I do this. We work week to week. The market changes wildly within a day or two. So it makes sense to me that OPEC would be coming and trying to do this. And again, when we say OPEC, we're really talking about Russia and Saudi Arabia coming together and managing this on a monthly basis so they can get ahead of this. And I think that does bode well for 50-ish plus oil prices.
So what do you think is going to happen in U.S. shale, and what do you think that the powers that be are missing about elasticity of U.S. supply?
I think that this $50 mark is it's been this magic number for shale that everybody's talked about, and we've talked about it. I mean, it's sort of the magic number that everything break evens at 50. But we've seen the rig count. I mean, right now the Permian Basin is at, according to Enervus, it's 185 rigs in the Permian Basin. We've ratcheted up that rig count every week basically since July, at a bottom of 127 rigs, and we've had $40-ish WTI from June onward, and it's slipped back at times, but the rig count has continued to move higher. And actually, if you look at productivity, surprisingly, it's not. One would expect productivity to actually decline in 2020. I mean, we shut in these wells, and any new wells we're bringing on, I wouldn't expect them to be, going gangbusters. But honestly, it's held up well. So if you normalize for lateral length and you're looking at cumulative production, or you're looking at just IPs, they're holding in line with 2019 numbers. So that's pretty impressive. That's like Williston Basin and Permian Basin, if you look at both of them just on the face of it. So I think that the skeptics are missing what happened basically in 2014, how resilient the industry is and how well it responded, and particularly the life of the rocks. I think the longevity of what these rocks have to give you, and the analytical framework we often think about is just like, okay, well, the rocks are tapped out or we hit this tier 1 acreage, and it's simple technologies. It's doing things faster. It's baking in those efficiency gains, and it's doing things better at a lower cost threshold. And so I think the market is, the market also may be anticipating that we're not going to have as much production. IEA actually shows in their outlook that production's at 11 million barrels per day next year. And so they're not really expecting any kind of resurgence. I think the ability from a technical capacity, and you and I have talked about this offline, the ability for the U.S. to actually get back to 13 million barrels per day technically is very feasible. But it's the question of whether or not the administration is going to really harp on, production is, I think it's looking in cabinet picks that happened this week, and all the talk on climate change being an existential threat. And I think production is going to be something they go after, which means OPEC has a lot of running room and they can do a lot. But I also think that the skeptics are probably not seeing what's going to happen to Texas. I really think Texas, if you look at the Eagle Ford rig count, that the rig count has come up a little bit as well. We've seen production really come off and hasn't really recovered. It's about 1 million barrels per day in the Eagle Ford, and there's a lot of running room. I think in terms of just like a rock perspective and productivity gains and what these operators can do, and the fact that Texas is all private, I think we're going to see a monster basin and all these other places as well.
On the gas side, we see the Arklatex being the biggest beneficiary of the decline in associated gas production, particularly the Haynesville. The Haynesville is pretty much ideally positioned to take care of LNG. The Northeast, surprisingly, and in particular, if MVP doesn't get done, could be gas constrained in a few years. And the Haynesville looks like it's going to attract most of the gas-directed capital.
A little bit in the Haynesville and the Marcellus, but can we talk about your perspective on the Permian side? Because if you pull up Permian production now, you realize that it was basically barrels per day in March, and gas production was like 17 BCF a day, and gas production came down, but has really recovered pretty well. So, what's your personal perspective, as well as maybe East Daily, and how you're thinking about the midstream piece? Because if you're just looking at water, crude, and gas within the Permian Basin, crude hasn't come back yet. Water's still down, but gas is coming back, and that's probably because you have the associated gas is coming up on some of these older wells. But can you just walk us through that a little bit? And really, are we if the Permian wants to go gangbusters next year, do we got to start worrying about gas capacity again?
Well, you're in luck because I'm going to show you a slide from our report, which just went out this week, Dirty Little Secrets, a shameless plug for East Daily's annual report. And this is our view of associated gas production in key oil basins. And this is based on the strip as of about a week ago. So you can see we don't see that bouncing back. Obviously, this will change quite a bit if we see, say, $60 oil prices. But we think, for the most part, associated gas is going to make a modest rebound into 21. And then, with the exception of growth in the Permian, where we actually see gas processing infrastructure, utilization looks pretty good in 2 to 3 years. The other oil basins aren't gonna show enough growth to supply that giant wedge of associated gas that was suppressing natural gas prices up until this year. We're still looking, we've seen a little bit of winter weather weakness on gas prices lately, but we still are very constructive on gas prices into 2021. And what's interesting is some of the side phenomena that are occurring. For example, gas capture in the Bakken is very high right now, as flaring has subsided because of the associated gas. The excess capacity is being taken up by gas plants, and we actually think gas capture by G&P is going to peak in 4Q, exceed the first quarter, which is kind of interesting. And ONEOK is actually going to, we think, post record company G&P volumes in the fourth quarter based on capturing gas and expanded capacity utilization there.
Okay. But so you would say then, with that chart that you showed and the fact that we know that Permian Basin gas has come back up to nearly almost 17 BCF at 16.8. So it's recovered. So you were suggesting that associated gas has come off considerably just because that oil is not going to come back nearly as quickly.
Yes. And,
okay.
One gating factor. So I want to point out, yes, there are pretty substantial changes that can happen, and there's basically no reliable confidence interval on oil prices in the next 6 months. If you put an 80 or 90% bracket around it, you're talking $15 or $20 a barrel in either direction. But what's different this time is that you've got forces keeping public companies in check. So they won't be able to accelerate drilling as much or as fast as they have been because of the pressure on bank lines. So the promises for free cash flow from E&Ps, investors are going to hold them more to that line of business strategy than they did when it was all about NAV growth and flip. They have to stand on their own feet, so to speak. And the same is true largely for midstream. They're a follower, not a leader. We think probably close to $200 billion in free cash flow through 2024 on midstream on a lack of CapEx, which is an enormous shift from a free cash flow deficit of $15 to $20 billion look back. So despite the lack of production, in a certain sense, the fundamental health of the companies, both in upstream and midstream, that have survived to this point ought to be better, and they ought to be able to keep some margin in place because the amount of capital being steered isn't as limitless as it was before. We still think that's going to be significant capital access, but nothing like the piles of money being thrown into the sector from, say, 2010 to 2014 in particular, and through 18, if you will.
Okay, I disagree a little bit with that, in that I think that the things that people don't appreciate are often that how easily adaptable companies are, how the private companies do go back to work. And I think all you have to do is look at the number of operators that were drilling. And I mean, you had 39 operators drilling in the Permian in July, and you have over 70 operators drilling now. And so the sheer volume in just the number of operators, when we think about, and again, this is the Permian, and we've talked about this before offline, and that it's, if you're looking at the Permian versus other places, it's different. But the amount of private companies and the amount of private equity companies in that space, it's way more than if you listen to any analyst on TV talking about the oil market, they would have told you that anybody drilling with one rig, these private equity-backed companies, they would have been done in April. And they're not done. They've actually come back. Some of them have actually drilled through it. And that's the piece where you asked about, like, what are people missing? I think that's what they're kind of missing. And they're also missing is that amount of private money that people are getting, there is some access to that private capital. There's still access to some private equity. And then that cash flow from operations, like when oil prices are $50 a barrel, many companies are making money. That free cash flow is generating the ability for them to make money. And
I think you're vehemently arguing with me in the same, we're saying the same thing in different ways. I absolutely believe that the capital.
Yeah, we are.
The capital. Wait, let me finish. The capital is going to coalesce in the Permian, but we're not going to have the flood of tier 2, tier 3 oil basin excess capital and activity that we had before. So the difference is we are really focused on economics in the places where it makes sense to do that. And the Permian's going to take the lion's share of oil-directed capital. Yes, there's a lot to finance that, but I don't think there's a lot of excess capital that's going to finance tier 2 and tier 3 drilling economics.
No, I don't think it's going to go to places that worse drilling economics, but I do think that depending upon the regulatory environment and, I think North Dakota could really thrive because the Wilson Basin just has excellent rock. But I mean, if we have problems with Dakota Access or Enbridge Line 5 or Keystone XL getting developed, which very well may happen under this administration, then hurt. If prices were to go to $60 a barrel, there's no worries because it's just going to go on rail. And even $55 a barrel, if you could make your economics work in the Bakken with 45 and you're railing for 10, I mean, we may see some stuff. I just think that the unique pressures this year if prices are at 50 and you have this unique regulatory environment which is pressuring, you're going to see everything where there's private land, you're going to see this honed in focus. And sometimes, even if the economics aren't perfect, you may see an acceleration that moves there. And I also think that the way that capital discipline and the ability for people to think about the rock differently and to perform differently. I mean, EOG is telling the market we can grow production at 8 to 10% at $50 oil. And they're also saying, hey, we're not going to grow production if the market's not balanced. I mean, so OPEC's going to have to say, hey, EOG, the market's not perfectly balanced, so please don't increase your output. I mean, and that's just not going to happen. I mean, because they can make money at 50 and they're going to, and the rig count suggests that's what they're doing. And you're right. Not everybody's going to be able.
Hold on. So if the entire industry was EOG, I would be wrong, but it's not. You know that.
Yeah, it's not. It's absolutely not. But I think that, and from a capital standpoint, and from the fiscal, from the ability to spend money, the ability to generate free cash flow, and the ability to be economically self-sufficient, the industry is not there. But in terms of like what the operators can do with the tools that they have, you always have this time when you're getting back to work where you still have cost compression on the service side. We're not going to see, service costs balloon overnight. We've actually seen them come back a little bit. Prices come elevated, but you're not going to see them go crazy because we don't have any of that frackers running. So folks that are entering now, or the private companies that have been doing this, or the tap rocks, or whoever they are that are still drilling in New Mexico, those guys are going to be they're going to continue to drill through this, and they're going to do it probably a little more aggressively and a little better than people think. So back in the day when Continental Resources was telling everyone, hey, we're the only ones doing this and we're doing great. Same thing as Aubrey McClendon when he was saying, hey, we're the only ones that can produce gas as well. And then everybody produced gas as well. I just think we have to be really careful about saying to that the industry is going to, level off, and they're going to be no more, people aren't going to perform in line with EOG, and they probably won't, but there are a lot of companies that are probably going to crush it next year in the Permian Basin and maybe elsewhere as well.
We need to figure out a way to operationalize our disagreement on this super PetroNerdy topic in a way that maybe one of us the loser has to send a bottle of wine to Chuck Yates or something like that. And so let's talk about the appointments. The Biden cabinet, not what a Wyoming like yourself would like. So the most interesting, I think, is his pick for Secretary of Interior, Deb Haaland. I'm not sure I'm saying her name right. Apologies if I am not. She is a progressive from New Mexico who appears to not be a big fan of oil and gas. And Wyoming had a study this week that basically calculated something around $700 billion and destroyed total economic value from a leasing or a drilling moratorium on federal lands. How do you think this is going to play out, Trisha?
It's a great question. I think that this world is going to look a lot different. I mean, 2021 with this new administration is just going to look a lot different. And this, there were some comments actually in the last few days with regards to climate change and the czars that, and I don't think I'm being too aggressive in saying that the czars that Biden's putting in place, but basically calling climate change an existential threat. So I think it's really clear that climate change and energy production is going to be a focus of this administration. And that pick on Interior, I mean, she's from New Mexico, and she's, I think in that, there was a Washington Post article and a couple other articles where she said directly, I care about all these jobs, and she's from there. But it's caring about the jobs and also being an advocate on what you're advocating for. It. I don't think we're going to be protecting those New Mexico oil and gas jobs. It looks much more like this is tilting in favor of these folks that are advocates on the climate change side. And it's just not, there's no favor to oil and gas because it's out of favor for a number of different reasons. So I think that the severance taxes from New Mexico, Wyoming, the risk is it Gulf of Mexico as well, and how quickly it goes down the pipeline, right? There is a little bit of time. I don't think this stuff happens overnight, and Biden isn't going to do I doubt he's going to do an executive order. So it is going to come from these recommendations by these cabinets. I'm sure they'll be doing studies. I'm sure some of those studies are going to be what impacts the actual drilling and completion of these wells going forward. So if you're an operator, you should be drilling and completing these wells as fast as humanly possible right now, because you have concern that stuff is going to come down the pipeline. And I think the industry just has to be really honest with itself on, especially these comments we've heard from Sharif Suki and from Bill Thomas and these folks about how easy it's going to be able to work with the Biden administration. I mean, these picks within the cabinet are not the same people you were dealing with under an Obama administration, right? It was very different. And Obama made it clear how he entered. I mean, he entered the Keystone debate by jumping on a radio show in Nebraska and sort of getting involved there. But I mean, he didn't actually get too involved in domestic oil and gas production. And in fact, he sort of allowed, to flourish and allowed exports to sort of go up for liquefied natural gas. And this, I mean, there's serious ramifications, I think, from a energy security geopolitical framework of just in a year from now, if we do indeed, as the IEA points out, if production is just 11 million barrels per day, I mean, a year from now, and we're importing that crude oil, I mean, that's 1 million barrels per day that we're getting from other countries. I mean, and if we don't actually get any of these pipelines fixed, if Line 5, you should comment on that, Ethan, on what's going to happen in the Midwest with the actual existing pipelines that are moving both Bakken crude and Canadian crude oil. I mean, if those are threatened, we're actually changing how we're moving domestic crude oil production now. And so that production could be further threatened, which means we're then importing those barrels. So not only that the Biden administration will be working on domestic climate change issues to impact, oil and gas production. And in turn, I mean, to be fair, I think they're going to go after methane leaks and methane. So I think from a flaring, capturing the flaring and everything that you commented there is big, but it's really going to be about methane emissions. And the fact that France thinks that we have some of the dirtiest gas in the world and they don't want to import our liquefied natural gas is one of these things. So I think the industry, and I told a reporter this week from Brink interviewed me on this and asked about methane emissions. And I said, this is already a focus of the industry. I think the industry is going to work really aggressively to measure it and to lower those emissions. But I believe now that we are on, it's standardized. So basically, it's not the actual emissions, it's the standard number that basically they set on U.S. emissions, and then that's what the shale industry looks like. So I think the industry has an ability to sort of innovate their way out of that. But the question is whether or not, it's going to look like sort of this Polis administration in Colorado, where you're not going to, you can evaluate permits, but it may take 10 months to evaluate permits and you may never actually get one. If that's what's going to happen under the Biden administration, I mean, yeah, the reality is you're going to see development of oil and gas get severely curtailed in all these states with federal land exposure. And that is going to have a direct impact on the jobs and the welfare of those states, and really going to have an impact on the money that they're bringing in. I mean, it's considerable. I mean, it's not a small little dent, and it's going to have an impact on those states' economies.
I think that is probably a good place for us to wrap this up. On a more positive note, the market will be closed at 1 p.m. Eastern on the 24th for Christmas Eve and closed on the 25th. So I'm not sure when this is going to air, but we will see you after Christmas. With that, I'm Ethan Bellamy from East Daily.
I am Trisha Curtis from PetroNerds, and we are your hosts, and we'll be back soon, apparently, for the next PetroNerds podcast.
Awesome. Thanks, Trisha.
Bye.